today, Nigeria's Debt Management Office is scheduled to hold its monthly bond auction for May this week. Ahead of the auction, Emmanuel Odiaka, the Managing Director and CEO of ECOB Capital, joins me to discuss what to expect from the fixed income and FX market this week. Thank you so much for joining me on the show today, Emmanuel. And I'd first like to get your sense from you, what you're expecting from the bond auction this week.
Thank you for having me, Kenneth. It's going to be a very interesting auction, considering the fact that the Debt Management Office revised its Q2 calendar, especially of interest. The offers they would be offering to market in June. At present, what we are seeing on the curve is being persistent demand on the curve, and we don't think that will change, considering the fact that the policies on almost still stand, and institutions like the PFAs have limitations on where to invest their assets in. So we think with the volume of between 20 billion that the debt management will be offering, on Wednesday we are going to see a rush of demand into that segment. But personally, I think that is a huge trap, going by what we have seen from the June revised offer from the Debt Management Office.
All right, but looking at that revision, though, I'm trying to understand what you think the DMO's strategy is going forward.
Well, the big challenge is DMO as a price taker trying to balance the present unofficial policy of trying to get as much from the market in terms of lower yield, trying to beat down market yields on its offer. We have seen demand fuel in the NCB section. We have also seen demand fuel in the bond space. However, with the deficit and gap in the budget, from the last interview that DG gave on Channel TV, she was very equivocal when she mentioned that it's the expectation that yields could be going up, going by the fact that government needs to borrow more, and that inflation was also going to tick up. And so these are going to be the interesting points when market price in these issues.
All right, but let's look at the state of play and understand what's happening here with the gradual easing of the lockdowns we're seeing, and we're seeing that impact trickle down into, and the production costs from oil trickle down into the price of oil right now. Looking at this new surge in oil, how do you see this impacting the markets going forward?
Well, only to the fact that oil constitutes more than 70% of government dollar revenue, it's a big fundamental issue to consider, especially with the exposure that government have in the debt market. Going forward, oil has ticked back to 35, so back at $1 the Brent. So that's a bit of relief. But I think this is an opportunity for government to make true its words to truly diversify the revenue base, and not just only diversify the economy. The economy is well diversified, but the challenge is that government revenues, oil still accounts for 70% of its revenue. So these are factors that markets will be looking at very, very keenly. Unfortunately, by OPEC quota, the Nigerian was forced to also reduce its production quota, which was presently about 2.1 million barrels, to about 1.6 or 1.7 million barrels at present. So these are factors that is going to add more pressure to the government revenue. And, oil is still oversupplied, but it's good news to see that the prices are beginning to tick up, but it's still not yet clear if this will be sustained. Because in my own opinion, I think normalcy will only come when COVID-19 is tackled headway by way of therapeutic solution, or by getting a vaccination to wipe out this disease pending human beings right now.
All right, but very quickly, Emmanuel, as we wrap the conversation, I'd like to get what your outlook is for inflation. We're supposed to get the figures in last week, but we're still seeing delays there. And also your outlook for the MPC next week as well.
I'm talking about inflation. Obviously, with what we have seen with imported inflation in terms of price transmission as a result of the lockdown, border closure, I think inflation may likely tick up between 13.5% to 14% in the short to medium term. And looking at MPC, well, it's going to be an interesting call. I think the Apex Bank will still try to balance the FX challenges it's presently facing. We hear that demands are not fully met in the market, although the Apex Bank has given market assurances that it will meet all legitimate demands. But like you know, in the parallel market today, the USD was priced at 455. So that's a huge challenge. How to balance the low interest rate drive, flexibility to the real sector that the Apex Bank is promoting, and also how to balance market expectations for higher yields. So vis-a-vis, we know that the Apex Bank's priority is in price stabilization, but something has to give way at this point in time. And if you ask me, I think the Apex Bank should look at relaxing the cash reserve ratio to banks to allow them more liquidity to lend to the real sector. And the Apex Bank should come up with measures also to ensure that it's not arbitrarily creating arbitrage for STIs in terms of OMO issuance where they sell at 12 for 5 and such issues come back to the market to trade at 10.5%. I think that's a disservice to both the Nigerian domestic market and to industry players.